I've seen a number of videos with people talking about paying off their mortgages extremely early, some in just 7 or 10 years. But does it make financial sense to do so? I'm going to explore the 3 key factors that would determine the answer, and I'm going to run through the numbers in an example to help show you that paying off might be a mistake. The argument for overpaying does sound sensible. You make overpayments, you get rid of one of the largest debts that you'll ever have, you free up those monthly mortgage repayments for savings, investings, or having fun, and there's also a massive mental benefit to paying off the mortgage early. However, what's the opportunity cost? Could you have used that money to invest? We'll explore the numbers after going through the key drivers in the argument. The first key factor is interest rates. We're at a point in time in the UK where the Bank of England base rate is extremely low. It's been 1% or lower for over 11 years now. Currently it's sat at 0.1% and has recently been extended to stay at 0.1%. That's really important if you're looking to get a mortgage or already have one. The base rate is the interest rate that lenders pay when they borrow from the Bank of England. So the lower the base rate, the cheaper it is for them to borrow. As a result, this means cheaper borrowing for consumers when getting a new mortgage or remortgaging. The idea behind the lower interest rates is to get business and consumers borrowing, spending and saving less, as returns of having your money sitting in a savings account are very, very low and the cost of borrowing is very cheap. With the current recession in the UK, we can be fairly confident the lower interest rates are here to stay for a while longer, with the government wanting to promote borrowing and spending to restart the economy. We've even seen in the news recently with the Bank of England being rumoured to be looking at negative interest rates. Whilst it does not impact current mortgage rates that much, as they're already very low and lenders need to make some money from lending, what it does signal is that low interest rates are here to stay. This makes it very interesting to look at this argument of overpaying versus investing because it's so cheap to borrow. That means on the flip side of the argument, you don't need to make as high returns every year for your money to make more financial sense being invested rather than making mortgage repayments. This takes us to the second key factor, expected future returns. What if you invested £200 every month? What are the expected future returns on that £200? Is it far greater than the mortgage interest rate? Well, it's impossible to know. Nothing is guaranteed. You could get lucky with fantastic returns of 20 plus a year, or equally unlucky with a terrible investment. So for the expected future returns, we have to be realistic. We will assume you put that £200 in a stocks and shares ISA and invest in a low-cost tracker fund. For example, the S&P 500. It began in 1926, and through to 2018, its averaged a return, which has been adjusted for inflation, of 7%. Throughout that time period, there's been world wars, multiple stock crashes, and a Great Depression. Again, it's not guaranteed, but it's probable. If you decided to invest that £200 into bonds or save that money in a cash ISA, well, the interest rates are so low now that it's going to be better to do the overpayments. However, for this argument, we're going to assume that you invest your money into a stocks and shares ISA and get a realistic return of around 7% per annum. The third and personal factor is risk appetite. As mentioned throughout the previous 2 factors, we can't guarantee anything, and that goes both for interest rates and expected future returns. If you're risk adverse, paying down a debt you're going to have might be the best option. At the end of the day, the decision doesn't have to be a financial one. It all depends on what your goals are in life. But assuming you've got this far into the video, you're probably weighing up the risk versus reward of investing or overpaying. So we need to ask ourselves, are these lower interest rates going to stick around for 2 years, 5 years, or 10 years, like since the last financial crisis? We don't know. Am I going to get an average return of 7% over the next 25 years? We don't know. So we have to make some assumptions and look at the historical data to make the most informed estimate that we can. As we're investing over a 25-year period, it's probable that we will get close to the average returns, as those historical averages include data from the worst times in history, as mentioned earlier. On the interest rate side, there is some risk mitigation by locking in a 5 or 10 year fixed interest rate mortgage, which can really help for a good proportion of the duration of a mortgage. As of March 2020, 10-year fixed mortgage interest rates were at the lowest since records began by the Bank of England at 2.36%. Finally, the decision isn't an either or. It will be for the example shortly, just to give you reference points on both extremes or ends of the argument. However, you could decide to split your money half and half of overpaying and investing, really to be able to split the risk. I've put the link in the description to this overpayment mortgage calculator on the Money Saving Expert website. We're going to put in 200k of mortgage debt. We're going to keep it at 25-year term, keep it on repayment. For interest rate, 3.5%. This is the most important part out of all of this here. Whilst there is much better interest rates in the UK at the moment, with a 5-year fix being 1.66%, 10-year fix being around 2.44%, we've put in 3.5% here because the interest rates might rise in the future, and we can't guarantee those lower interest rates for the future as well. So 3.5% factors in some risk of the interest rate rising. We're going to put in £200 a month overpayments here. So overpaying just £200 a month would save £26,217 of interest alone, and you pay off the debt 5 years, 11 months earlier. £1,002 is how much you'll be paying on a monthly basis. Again, that's an average. If you have a lower interest rate at the beginning of the mortgage, you might start paying off less, and then you might be paying slightly more at a later date if the interest rates do rise. So we know how much we'll save initially with the overpayments. £26,217 in interest, that's a saving. However, we now also have 5 years and 11 months worth of not paying £1,002 per month. We will revisit that again after this next calculation of what those £200 a month overpayments could have been worth. Let's go to a compounding calculator now. We're going to start with £0. Interest rate, we're going to assume we put the money in the S&P 500. Average return adjusted for inflation is 7%. Calculation period, we're going to keep it at 25 years, put that onto monthly. And for monthly deposit, we're going to put £200. If we click calculate, the final investment value just under 163k, roughly 103k, which is completely free through interest. Not too bad. That's how much your £200 a month is worth after 25 years of compound interest. On face value, that's far, far better than saving 26k of interest by overpaying on your mortgage. However, what we also need to do now is calculate the 5 years and 11 months of investing with the freed up cash flow from the early repayment. So for this example, we're going to start with £0. Interest rate is 7% again, to be fair. Change the calculation period to months, as we want 5 years and 11 months. So 71. Monthly deposit is going to be £200, plus the £1,002 per month, which would have been used to pay off the mortgage. So £1,202. Final investment value is just under 106k. If we add these savings to that, we get a grand total of around 132k. By investing, we get 163k. With overpaying and then reinvesting the savings, you get 132k. So you're 30k better off by not overpaying. It actually doesn't matter how much you overpay by. We could change that number from 200 to 400. All that really matters is the percentages of interest on your mortgage and the expected future returns from stocks and shares over a 25-year period. With a 25-year period, the probability of having average returns of 7% are a lot higher. Again, it's all about risk appetite. Even if we change the expected future returns to 6%, you'd still be 7k better off. So really what we need is the returns to be 2.5% higher than the interest rate. So to summarise, the three key factors in this argument are interest rates, as these will impact how much money you have to pay back over the mortgage length. Expected future returns, this rate will determine if it's worth investing rather than overpaying. You need this to be at least 2.5% higher than the average rate of interest on your mortgage. Finally, risk. There's no guarantees with interest rates staying the same, and with your expected future returns. So taking into account if you're risk adverse or risk tolerant will really impact your decision. Looking through the numbers, it can make more financial sense to invest rather than overpay. However, nothing is guaranteed, and you will have to accept the risks associated with your decision, or accept potentially forgoing a potentially decent chunk of money. Thank you for watching. If you have any questions or comments, please drop me a message or drop a message in the comment description below. If you haven't already, please consider subscribing for future content.